My next guest says the recent pullback is likely headed towards a full-blown market correction and that investors should take the next few weeks to reload investments in more cyclical areas of the market. Let's welcome in Steve Auth. He's the Chief Investment Officer for Equities at Federated Hermes. Steve, it's great to have you back. Welcome.
Thanks, Kelly.
Are you a little... What's the conviction level in this correction? Let me put it this way. Should people already be reloading on the reopening trade? Or?
Absolutely.
Okay.
Yeah, no, our conviction level's higher, Kelly, in the year. And we actually raised our year-end number to 40. It's been 4,500, as you know, all year. We just raised it to 4,800. So we think the current correction probably has a little bit longer to go once people start to digest Fed tapering, which we think is coming. And I think the tax hikes, which the market is still kind of blowing off, we do think they're likely to come through. So, that'll take a little off the earnings numbers for the S&P. I think the vulnerability in the market here, Kelly, is really the stocks that have held us up. I mean, you look at all the stocks that we like here, they're down 10 to 20% in the week. So the market looks like it's hanging on, but it's largely because the large cap growth stocks, which have become the long duration plays in the market. So if we get a little pressure, once the Fed starts tapering, that supply and demand imbalance in treasuries starts to come away. And I think that's when the event that everyone's been predicting all year begins to happen, which is you start seeing yields go to a more normal level, given what we're seeing in economic growth and inflation. So that's going to take a little bit of the air out of the big cap tech names. I think, their earnings power can carry them into next year. But that's where, if there is a correction at all, where we are, that's got to be where it's going to be.
So let me rattle off, and we've been showing some of these as well. You have a lot of specific picks. In financials, you like COF. Travel, you like United. Autos, you like GM. I want to focus in, though, on energy in particular. Not that you're the oil analyst here, Steve, but you guys do have a $90 oil call. We see this exacerbation in global energy prices, whether oil or nat gas. What would your advice be to investors here?
Yeah, I think people have given up on this space. It's been a terrible space to be. The standard line is that, the only thing that corrects oil prices is high oil prices. Even the companies hate investing right now. We think the ESG factor is another factor to play here. The big call for us, Kelly, isn't so much $90, although when we put it out at the beginning of the year, I think people thought we were crazy. It's more that next year we're going to stay up and elevated. And I think the reason these stocks aren't being bought is because people think, well, even if we do see a short-term COVID-driven hike in prices, it'll all come back down. That's not what we're seeing. The oil companies are not reinvesting in this space. They're paying out the cash. We like Schlumberger here because they're a big player in squeezing more oil out of existing wells and a big player internationally, which is where the reaction is going to be, given where the current administration is on energy, on carbon energy. So we think there's a play here, and people are really underexposed. It's also an inflation hedge, and we see that lasting longer than most people think as well. So, and these stocks are some of the cheapest stocks in the market.